In the beginning, there was no money. Societies relied on barter, the direct exchange of goods and services. A farmer might trade a bushel of wheat for a blacksmith's tools. This system had limitations. Finding someone who wanted what you had and had what you wanted was difficult. This was called the double coincidence of wants. Imagine trying to find someone who wants your spare fishing net and also happens to have the clay pot you need. It was inefficient and limited economic growth. Barter also made it hard to value items. How many chickens equaled a cow? What if the cow was old? These challenges highlighted the need for a more efficient system. People needed a common medium of exchange, something that everyone valued and could easily trade. This need led to the emergence of money. Early societies transitioned from barter to using commodity money. In the beginning, people exchanged goods and services directly, but this system had its limitations. It was often difficult to find someone who had what you needed and who also wanted what you had to offer. This involved using valuable, durable, and divisible goods as a medium of exchange. These goods needed to be widely accepted and recognized for their value. Cattle, grain, salt, and shells were early forms of money. Each of these commodities had specific advantages. For example, cattle were valuable for their meat and labor, while grain was essential for sustenance. These commodities had intrinsic value. They were not just symbols of wealth, but were useful in everyday life. They were useful on their own, but also became a means of payment. This dual purpose made them highly effective as early forms of money. Over time, precious metals like gold and silver emerged as preferred forms of commodity money. These metals were not only valuable, but also had the advantage of being durable and easy to transport. They were rare, durable, divisible, and easily recognizable. This made them ideal for use in trade and commerce. Gold and silver coins became standardized forms of currency in many parts of the world. The process of minting coins ensured that each coin had a consistent weight and value. The use of precious metals as money simplified trade and facilitated economic growth. This development marked a significant advancement in the history of human commerce, laying the foundation for modern economic systems. However, carrying and storing large quantities of gold and silver posed challenges. This led to innovations in banking and the development of paper money. The journey from barter to commodity money marked a significant step in the evolution of economic systems, paving the way for more sophisticated financial practices. The safekeeping of precious metals played a crucial role in the development of banking. In ancient times, people needed a secure place to store their valuable gold and silver. This need for security led to the rise of goldsmiths, who had the necessary skills and facilities to safeguard these precious metals. In the 17th century, goldsmiths, with their secure vaults, became the custodians of people's gold. They were trusted not only for their craftsmanship, but also for their ability to protect wealth. As more people deposited their gold with goldsmiths, these artisans evolved into early bankers. They issued receipts to depositors acknowledging the amount of gold held in safekeeping. These receipts served as proof of ownership and could be redeemed for the actual gold at any time. This system provided a convenient way for people to manage their wealth without the need to physically handle the gold. These receipts, initially a simple acknowledgement of deposit, gradually transformed into a form of paper money. Over time, people began to trust these paper receipts as much as the gold itself. This trust was crucial for the next stage of financial evolution. People began using these receipts as a medium of exchange. Instead of carrying heavy gold coins, they could trade these lightweight paper receipts for goods and services. This made transactions easier and more efficient, paving the way for modern banking practices. Instead of withdrawing and transferring actual gold, they traded the receipts, which represented claims to the gold held by the goldsmiths. This system allowed for greater flexibility and liquidity in the economy, as people could conduct business without the physical transfer of gold. This marked the birth of paper money and the early stages of banking. The convenience and security of using paper receipts instead of gold coins revolutionized commerce and laid the foundation for the banking systems we know today. Goldsmiths, recognizing the potential of this system, realized they could lend out a portion of the deposited gold and earn interest. This practice of lending and earning interest was the beginning of what we now consider traditional banking activities. They issued more receipts than the gold they held in reserve, effectively creating money. This overissuance of receipts allowed for the expansion of credit and the growth of the economy, but it also introduced new risks and challenges that would shape the future of banking. This practice, known as fractional reserve banking, became a cornerstone of modern banking systems. Fractional reserve banking is a system where banks hold a fraction of deposits as reserves. This system is fundamental to the way modern banking operates and is a key driver of economic activity. Banks lend out the remaining deposits to individuals and businesses, which allows them to create new money in the economy. This practice is what enables banks to generate profits and support economic growth. When a bank receives a deposit, it sets aside a portion as required reserves, determined by the reserve requirements set by central banks. These reserves are crucial for maintaining the stability and liquidity of the banking system. The bank can then lend out the remaining portion, known as excess reserves. These excess reserves are the primary source of new loans and credit in the economy. The borrower receives these funds as a loan and deposits them into their account. This deposit then becomes part of the bank's reserves, allowing the cycle to continue. This creates a new deposit from which the bank can again lend out a portion, further increasing the money supply. Each new loan and deposit cycle amplifies the amount of money circulating in the economy. This cycle of lending, depositing, and relending expands the money supply beyond the initial deposit. It's a continuous process that fuels economic activity and growth. The reserve requirement ensures that banks maintain a certain level of reserves to meet withdrawal demands. This requirement is a safeguard to ensure that banks can meet their obligations to depositors. However, it also allows banks to create money through lending. By managing their reserves and lending practices, banks play a crucial role in the expansion of the money supply and the overall economy. Fractional reserve banking, while controversial for its potential risks, has been instrumental in facilitating economic growth by providing credit and stimulating investment. If you found this video informative, please like and subscribe for more content on the history of money.